Please like, share, and subscribe. Wishing you happiness and good luck every day.
Today, we are going to unpack the core philosophy of, well, one of the greatest investors of all time, Warren Buffett. And we're going to do it by looking at insights from the Tao of Warren Buffett, which is this incredible collection of his smartest, punchiest sayings. It's the perfect way to really get inside his head and understand how he sees money, business, and, life itself. Okay, let's just dive right in with an absolute classic. This one sentence tells you almost everything you need to know about Buffett's spirit. He's a contrarian. He's skeptical of the so-called experts. It's just the perfect setup for understanding his incredibly unique and independent way of thinking. And that skepticism leads us straight to the bedrock of his entire philosophy. You can forget all the complicated strategies and the get-rich-quick schemes. For Buffett, it all starts with one core idea: avoiding loss. So, what's the big secret? If you ask the Oracle of Omaha himself what the key to building wealth is, you might expect some complex secret formula, right? Well, his answer is actually stunningly simple and way more profound than you'd think. And there you have it. That's it, the foundation of his entire fortune. Now, I know what you're thinking. It sounds almost too simple, right? Never lose money. But the power in this rule isn't just in the words. It's about protecting your starting capital so you can unleash the awesome power of compounding. And this, right here, shows you exactly why rule number 1 is everything. Look at investor B. They might have started with the same amount as investor A, but they took a massive 90% hit early on. Now, even though they get the exact same return from that point forward, look at the difference. It's not even close. That one early loss just demolishes their future. So you see, protecting your money isn't just playing defense. It's actually the most powerful offensive move you can make. So, okay, if rule number 1 is all about defense, how does he play offense? What's his strategy for actually making money? Well, the secret is a huge mental shift in how you look at the stock market itself. This is so important. You have to stop treating stocks like they're just little tickers flashing on a screen, like some kind of lottery ticket. You're not gambling. A stock is a small piece of a real, living, breathing business. And when you start thinking like an owner of that business, everything changes. Buffett made his fortune finding what he calls wonderful businesses. And a lot of them are these incredible, sometimes family-run empires built on a single, powerful, and often simple idea. He's not chasing the next flashy thing. He's looking for the unshakable pillars of our economy. So what's the common thread here? What do all these great businesses have? It's a little something Buffett calls a durable competitive advantage. Just think of it like a castle. A really great business is the castle, and its advantage is a giant protective moat around it that's almost impossible for competitors to cross. And this quote just nails his whole point. It's so brilliant. He looks for businesses so simple, so ingrained in who we are, that they're practically future-proof. Sure, technology can change a lot of things, but it's probably not going to change our basic human habits. And that's where he finds incredible long-term value. All right, this brings us to what might just be the hardest part of Buffett's philosophy to actually put into practice. It's all about controlling the single biggest threat to any investor. And it's not the market, it's your own emotions. Honestly, a huge part of Buffett's success comes from one simple strategy: doing the exact opposite of what the crowd is doing. When everyone is greedy and piling into popular stocks, he's cautious. And when everyone is terrified and selling off great companies for cheap, that's when he gets greedy. It's all about ignoring the herd and thinking for yourself. I mean, does any quote sum him up better than this? This is pure conviction. For him, the best investment advice doesn't come from a big committee of so-called experts. It comes from his own research, his own logic, and his own quiet confidence. And finally, let's zoom out, because this is where we get to the real Tao of Warren Buffett, the principles that go way beyond just a stock portfolio and really show you how he thinks about living a good and successful life. This right here, this is what he believes is your single most valuable asset. Not money, but your integrity, your reputation. It takes decades of hard work to build it up, but just one bad decision to burn it all to the ground. When you really think about that, it changes the way you make every decision in business and in life. So it all leads to this question, right? For a man who has completely mastered the game of making money, what's the real endgame? What's the true definition of a life well lived? Is it just the final number in the bank account? And that's the answer. It's so human, and it's so profound. For Buffett, All the money on earth is worthless if you get to the end of your life and the people you care about most don't love you back. Without that love from your family and friends, you are, as he says, the poorest person in the world. You know, Buffett has this great line where he says he doesn't try to jump over 7-foot bars. He looks around for the 1-foot bars that he can just step over. He seeks simplicity. So that leaves us with one final thought to take away from all this. What's the simple 1-foot bar you can step over in your own life today to start building a richer, more meaningful future for yourself? You know, for decades, when you think about wealth and wisdom, one name probably pops into your head: Warren Buffett. But his playbook for success isn't about some complicated algorithm or crazy risky bets. Nope. It's built on a set of timeless and, honestly, surprisingly simple rules for getting rich. And, maybe even more importantly, staying rich. This is probably Buffett's most famous quotes. And look, I get it. On the surface, it sounds, well, a little obvious, doesn't it? But it's not about avoiding risk altogether. It's actually the foundation of a really deep philosophy about protecting your single most valuable asset, your starting capital. Because before you can even dream about winning, you have to make absolutely sure you stay in the game. And that's what we're going to dive into first. Let's talk about playing defense. Now, this isn't the glamorous, exciting part of investing, but I promise you, it is, without a doubt, the most important. It's all about building a financial fortress before you even think about going on the attack. See, the real secret to building wealth isn't about hitting some crazy home run stock pick. It's all about the slow, steady, just relentless power of compounding. And the single biggest factor in how big your financial snowball gets is the amount of snow you start with. A major loss doesn't just set you back, it basically kneecaps your entire future earning potential. Okay, just look at these numbers. It's kind of wild when you see it laid out. If you take $100,000 and let it compound at a pretty healthy 15% for 20 years, it grows into more than $1.6 million. That initial capital, that $100K, generates over $1.5 million in pure profit. That is the magic of compounding in action. But this is where it gets really mind-blowing. Look at the absolutely devastating impact of a huge loss. Let's say you lost 90% of that starting cash, leaving you with just 10 grand. That same 15% return over 20 years, it only gets you a little over $150,000 in profit. The difference is just staggering. You didn't just lose $90,000, you lost well over $1 million in future gains. And that, right there, is why rule number 1 is everything. Okay, so another huge piece of playing defense is just foresight. Buffett learned this one the hard way when he bought the Nebraska Furniture Mart from the legendary Rose Blumkin. He forgot one tiny little thing in the contract, a non-compete clause. So a few years later, she quits, opens up a new store right across the street, and starts absolutely crushing his business. He had to buy her out all over again. The lesson? Think through every single possible outcome before you commit. All right, so once you've built that fortress, once your defense is solid, then you've earned the right to play a powerful, focused offense. And for Buffett, that offense is all about one crucial shift in your mindset. You got to stop thinking like a stock picker and start thinking like a business owner. You know, all the mainstream advice out there tells you to diversify, right? Spread your money around, don't put all your eggs in one basket. But Buffett, he argues the exact opposite. He believes that real generational wealth is created by going deep, by finding one truly exceptional business and sticking with it. It's about concentration, not diversification. And just think about it. You can see this principle in action when you look at some of the greatest family fortunes. The Wrigleys, the Waltons, the Gates family. They didn't build their wealth by owning 100 different stocks. No way. They built it on the back of a single dominant business that they understood inside and out. So, what exactly makes a business wonderful in Buffett's eyes? Well, it comes down to this one idea: a durable competitive advantage, or what he famously calls a moat. It's that special thing that protects a company from competitors, like a castle moat. It could be a super powerful brand, a key patent, or just being a lowest cost producer. I mean, when you think of soda, you probably think of Coke. That, my friends, is a moat. And this really is the key. It's about a complete shift in how you think. You have to stop seeing stocks as these little ticker symbols blinking on a screen and start seeing them for what they really are: a tiny piece of ownership in an actual business. Before buying even one share, Buffett asks himself a simple question: would I be happy to own the entire company at this price? That one question just filters out almost all of the speculative noise. Okay, so the strategy of buying great businesses at a fair price, It sounds pretty simple on paper, right? But here's the thing, it is not easy. What separates the winners from the losers usually isn't intelligence, it's psychology. It's about mastering your own emotions. And Buffett learned this lesson the hard way when he was just 11 years old. He bought his very first stock, a company called City Services, for 38 bucks a share. Almost immediately it tanked, dropping all the way to 27. Can you imagine the panic for a little kid? He held on for dear life. And when it finally recovered to 40, he sold in a wave of relief, pocketing a tiny profit. And then he had to watch in total agony as that stock shot up to $200 a share. Ouch. The lesson that was just seared into his brain that day was so simple. Patience. If you've done your homework and you bought a piece of a wonderful business, the hardest part is often just sitting on your hands and letting that business work its magic. The biggest rewards almost always go to the people who can just wait. And playing the long game also means you have to think for yourself. Buffett's biggest, most legendary wins, we're talking American Express, The Washington Post, Geico, they all came when he was buying what everybody else was desperately trying to sell. He wasn't looking for a pat on the back. He was looking for value that the crowd was just too terrified to see. I mean, you can really see the fundamental difference here. On one side, you've got the herd. They crave the comfort of consensus. They buy when everyone's excited, they sell when everyone's panicking. Then you've got the independent thinker. They do their own homework, trust their own research, and are perfectly comfortable standing alone, because they know that's often where the real opportunities are hiding. You know, this whole idea of independent thinking, it leads us to our next big principle. And this one has nothing to do with spreadsheets or financial statements. For Buffett, the character of the people you do business with is every bit as important as the financials. In fact, he sees it as a form of capital itself. It's such a simple rule, but it is so incredibly true. Integrity is just non-negotiable. He saw this firsthand watching the investment bank Salomon Brothers get into a gigantic mess dealing with the notoriously shady Robert Maxwell. The lesson? It doesn't matter how amazing a deal looks on paper. If you can't trust the person on the other side of the table, you just walk away. Period. Reputation is everything. It is an asset that is so slowly and painstakingly built over an entire lifetime, but it can be absolutely vaporized in an instant by one stupid decision. Just thinking about that simple truth, Buffett says, is one of the best ways to guide yourself toward making the right ethical choices. And this is the core message he pounds into his managers. It's the absolute heart of how Berkshire Hathaway operates. Money can be lost and it can be made again, but a loss of reputation, that's permanent. That's unforgivable. As he likes to say, there's plenty of money to be made by playing in the center of the court without ever getting close to the ethical sidelines. So this all brings us to the real bottom line. You know, after all the rules, all the strategies, all the billions of dollars, what is the point? What's the end game? Well, Buffett's answer might actually surprise you. That's it. That is his definition of success. After a lifetime of incredible financial achievement, his ultimate measure of a life well lived has absolutely nothing to do with a bank balance. It all comes down to the love of your family and friends. He says you can be the richest person in the world, but if you get to the end of your life and you don't have that love, you're also the poorest. Which really just leaves us all with one final thought to chew on. If Buffett is right, if all this money is just a means to an end and not the end itself, then the real question for you, for me, for all of us is, what are we trying to build with the resources we have? Right, let's get right into it. When you hear the name Warren Buffett, you're probably thinking about picking stocks, right? But here's the thing. His real genius isn't just about investing money. It's this incredibly powerful framework for understanding what makes any business, and I mean any business, either succeed or fail. So today, we're going to break down his 3 golden rules for judging a business, and you might be surprised just how much this applies to your own life. So we're going to start with an idea from Buffett that's, well, it's pretty counterintuitive. You know how we always celebrate these brilliant, visionary CEOs, these larger-than-life figures. Well, Buffett says that in the long run, the genius running the show matters a whole lot less than the fundamental quality of the business itself. In this quote, man, this is the core of it all. It completely flips the script on what we think matters. What Buffett is saying here is that a bad business, one with terrible economics, will basically chew up and spit out even the smartest manager on the planet. The business's own broken nature will always win. It's a huge reminder that you just can't outsmart a fundamentally bad system. Which, of course, leads to the big question, right? If it's not all about having a genius in the corner office, then what are the secret ingredients? What actually makes a business great? What should you and I be looking for? This is where Buffett's ideas get super practical. So, how does he do it? How does Buffett tell the winners from the losers? He has this really clear, almost fairy tale way of looking at it. For him, it's all about knowing the difference between a prince and a whole lot of frogs. And this little phrase? It says it all. The business world is just littered with these struggling companies that look like a bargain, These so-called turnaround opportunities. Buffett calls them the frogs. And he learned a long, long time ago that trying to fix them, hoping for that one magic kiss that turns the frog into a prince, is almost always a total waste of time and money. In fact, he's actually run the numbers on this. He says that something like 95% of the frogs that CEOs try to kiss, well, they just end up being bigger, uglier frogs. A bad business tends to stay a bad business, no matter how cheap it looks. The real secret, the real goal, is to find an already wonderful business and just buy it at a fair price. So what's the difference? How do you spot one from the other? Well, as you can see, it's not subtle. A great business is just gushing cash. It has very little debt, which means it can grow without constantly needing to borrow more money. The frogs, on the other hand, are always starving for cash. They're drowning in debt, and they're just stumbling from one crisis to the next. This quote right here perfectly captures one of the most important qualities of a great business for Buffett: predictability. He absolutely loves companies like Wrigley's Chewing Gum because their business is just so simple and durable. It doesn't matter what new app or technology comes out, the basic act of chewing gum isn't going anywhere. And this is the key takeaway. Boring is beautiful. A business with a consistent product, think Coca-Cola or Budweiser, generates incredibly consistent earnings. They don't have to pour billions and billions into research and development just to stay in the game, and they're not at the mercy of some new trend or fashion. They are just predictable, cash-generating machines. Now, here's the flip side. A difficult, super competitive business is like a kitchen that's infested with cockroaches. As soon as you solve one problem, maybe it's a supply chain issue, another one, like a new competitor, just pops right up. These companies are in a constant, brutal fight for survival, and it just drains all their cash. That makes them a terrible place to put your money long term. Okay, so let's say you've actually found one. You've identified a truly great business. Well, the next part of Buffett's philosophy is maybe the hardest part: having the discipline to avoid the common traps that can turn a winning situation into an absolute disaster. The first trap is what you might call hyperactivity. Buffett's joking here, but his point is dead serious. So many CEOs feel this constant pressure to do something, make a big deal, acquire another company. It makes them feel like they're earning their huge paychecks. But way too often, all they're really doing is buying a whole new set of problems, instead of focusing on the business they already have. Next up, the trap of weak accounting. And this one is a massive red flag. When a business has lousy economics and the people in charge aren't, well, let's just say they lack integrity, they get really tempted to start playing games with the numbers. They create earnings on paper that don't actually exist in the real world. It's a short-term trick that might make things look good for a quarter, but it's a sure sign of a much deeper systemic rot. And finally, there's this trap of going down market, which is something even really great brands can fall for. See, to get a quick sales boost, a company might start using cheaper ingredients or cheaper materials. But what they're really doing is risking something priceless: their reputation, the trust they've built with customers over years, even decades. And once that trust is gone, it is so hard to ever get it back. Okay, so this is where everything we've talked about gets really personal. We've been talking about investing money, but what about the biggest investment you'll ever make? What about investing your time, your talent, your career? Buffett says these exact same rules are absolutely critical for managing your own professional life. This is such a powerful way to think about it. Choosing where you work is a massive investment. And just like with stocks, you want to get on the right train, a company with a powerful engine that's headed in the right direction. You don't get extra points for choosing a difficult path. So what does that actually look like? Well, if you work for a company with great economics, that's the first-class train. It's going to be flush with cash, and that means higher salaries, more frequent promotions, and way more opportunities for you to grow and advance. But if you find yourself on that freight train to nowhere, a company with poor economics, you're going to face constant cost-cutting, below-average pay, and, frankly, a much higher risk of losing your job. So I'll leave you with this one simple question. If you look at your own career through this Buffett lens, which train are you on? Are you investing your single most valuable asset, your time, in a first-class operation? Or are you on that freight train to nowhere? It's a question that could change everything.
When you hear the name Warren Buffett, you probably think investing genius, right? But here's the thing. His incredible success, it didn't just appear out of nowhere. He built his entire empire on a foundation laid by other people. He stood on the shoulders of giants. So today, let's dig into the minds that actually built the master. I love this quote. It's perfect for Buffett's story, isn't it? The trees in his life, well, those were his mentors. And the shade they provided was this incredible foundation of knowledge that let his own fortune grow and grow for decades. And that's exactly what we're going to do. We're going to trace the evolution of the world's greatest investor by looking at the two key people who completely shaped his thinking, and of course, his massive fortune. Okay, so first up, we have to talk about Benjamin Graham. This guy was a legend. They called him the Dean of Wall Street. And for Buffett, he was everything. He was his professor, his first boss. You could even say he gave Buffett his very first operating system for how to think about investing. And this right here, this is Graham's single most important idea, the margin of safety. Look, this isn't some get-rich-quick scheme. It's actually the opposite. It's a defensive move. It's all about building a cushion, a buffer, to protect yourself when, not if, you make a mistake, or you get unlucky, or the market just goes haywire. To put it really simply, Graham's whole thing was that your best protection is the price you pay. That's it. If you can buy a dollar for 50 cents, you've automatically built in this huge safety net for yourself. And this quote, it just shows you what a contrarian Graham was. He taught Buffett that you have to run in the opposite direction of the crowd. Why? Because when everyone is cheering for a stock, the price gets jacked up, and poof, your margin of safety's gone. The real deals, the real bargains are hiding in the stuff nobody's paying attention to. So you can see the Graham doctrine was, well, it was brutally simple. It was all numbers, almost like a machine. Forget the hypey story. Forget the industry. Definitely forget what your neighbor is telling you. You just look at the numbers. Is it cheap? Yes, buy. No, walk away. And the actual quality of the business? Yeah, that was way, way down the list of priorities. But, and this is a big but, Graham's way of thinking wasn't the end of the story, not even close. Because another giant was about to enter the picture, a guy who would challenge pretty much everything Buffett had learned up to this point. And his name was Phil Fisher. Fisher basically took Graham's entire philosophy and flipped it right on its head. He said, look, the most important thing isn't the price, it's the quality of the business you're buying. He was hunting for truly exceptional companies, the ones that had a long-lasting edge over their competition. I mean, the difference here is just night and day. Graham was like a bargain hunter, digging through the bins for what he called cigar butts, these beat-up companies that had maybe one last puff of profit left in them. Fisher, he was the total opposite. He was like a collector of fine art, buying absolute masterpieces that he planned to hold on to forever, just letting their value grow and compound over time. Okay, so this is where things get really interesting. This is where the Buffett magic really happens. See, his true stroke of genius wasn't picking Team Graham or Team Fisher. It was realizing, wait a minute, I don't have to choose at all. He cooked up a whole new recipe. He took Graham's strict discipline on price, that margin of safety was non-negotiable, and he mixed it with Fisher's obsession with finding high-quality businesses. And what he ended up with was a philosophy that was way more powerful than either one by itself. And that, right there, is the secret sauce. That's why Warren Buffett ended up becoming so much wealthier than even his brilliant mentors. He literally took the best of both worlds and built this incredible compounding machine that was all his. But we're not done yet. There is one more absolutely crucial lesson in all of this. It's not enough to just find a great strategy. You also have to know when it's time to change it. Because, even a leopard sometimes has to change its spots. Think about it. By the time the 60s and 70s rolled around, the world was a different place. Everybody and their brother had read Graham's books. So many people were using his cigar butt strategy that all those easy bargains, they were basically drying up. The map he was using just didn't work for the new landscape anymore. This chart just lays it all out so perfectly.
you've got the old Warren, right? The Graham disciple. He was buying things like struggling textile mills just because the numbers said they were cheap. But then you get the new Warren, the one who listened to Fisher. He starts buying global giants like Coca-Cola. And the result of that one shift, it's what took him from just being rich to being super rich.
And let me just put a number on this for you. For Coca-Cola, he paid about 20 times its earnings. Now, you got to understand, for a diehard Graham follower, that price was just insane. Completely unthinkable. Way, way too expensive.
This is where Buffett learned one of his most important lessons, and it's a big one. It's so much better to pay a fair price for a wonderful business than it is to pay a wonderful price for a fair or mediocre business. His whole idea of what value even meant had totally changed. It wasn't just about the numbers on a balance sheet anymore.
And here it is, from the man himself. This quote just perfectly wraps up this whole journey, doesn't it? A real principle isn't some rule you just follow blindly no matter what. It's a deep-seated understanding that has to be flexible enough to adapt when the world changes around you.
So that kind of leaves us with a final thought, or maybe a challenge. Buffett's greatest strength wasn't just that he was smart. It was his willingness to keep learning, to adapt, and to throw out old ideas, even ones that made him rich, when they stopped working. So it makes you wonder, right? What about us? Which of our own core beliefs might be ready for an upgrade?
So, get this, one of the world's most successful investors thinks you already have all the tools you need to get rich. Today, we're going to break down Warren Buffett's investing philosophy, and you know what? It's way simpler than you think.
All right, let's jump right in. Do you really need some fancy degree in finance to make it big? To invest like a billionaire? Well, according to Warren Buffett, not only is that wrong, but that kind of thinking might actually be what's holding you back.
Okay, first things first. We have got to tackle this huge myth, this idea that investing is this super complicated thing that only, math whizzes can figure out. Because Buffett, he thinks that's completely backwards.
And you gotta love this quote. It's classic Buffett. He's basically saying, if you needed calculus to be a great investor, he'd still be out there delivering newspapers. I mean, it's such a freeing idea, right? It's this reminder that just good old-fashioned common sense, that's what really matters, not all this crazy complexity. And this just lays it out perfectly. I mean, look at this. On one side, you have what Wall Street wants you to think you need, calculus, these insane financial models. And then there's Buffett's reality. Addition, subtraction, multiplication, stuff we all learned back in grade school. It really is that straightforward.
So the big point here, and this is huge, is that you've already got the skills. You have the tools you need. Anything more than that is just noise. A lot of the time, it's noise that's created on purpose to make you think, oh, this is too complicated, I need to pay an expert.
Okay, so if it's not about complicated math, then what is the secret? Well, that brings us to the next big piece of the puzzle. And this is where Buffett's thinking really goes against the grain. We're talking about escaping the herd.
And this is it's so incredibly insightful. He says it just amazes him how really high IQ people will just mindlessly imitate what everyone else is doing. I mean, think about it. Back in the dot-com bubble, right? You had some of the absolute smartest people on the planet just throwing money at tech stocks for no other reason than, because everyone else was. And where was Buffett? He was just sitting back, watching and waiting for that whole stampede to run right off a cliff.
Yeah, this comes right from the man himself. You see, the whole game on Wall Street is built around selling you what's hot, what's popular right now. But Buffett, he's playing a totally different game. He's looking to buy what's unpopular. He's a contrarian through and through, and honestly, that's a huge part of his genius.
It really is the difference between just following a trend and actually setting one. You can see it right here. The herd mentality is all about imitating, buying what's popular, following the crowd. It's reactive. But Buffett's way is about thinking for yourself, finding value where nobody else is looking, and forging your own path. He's playing chess while everyone else is playing checkers.
So really, it comes down to this. Do you want to just follow the crowd, getting what he calls scraping your shoes results? Or do you want to be the one who uncovers real value precisely because you were willing to look where no one else was? It's a pretty clear choice when you put it that way.
Okay, but wait. Going your own way, that sounds risky, doesn't it? And you're right, it can be, which is exactly why this next principle from Buffett is so critical. And it's all about learning from failure, but, and this is key, not necessarily your own failures.
I mean, think about it like this. You can learn that a stove is hot by touching it and getting a nasty burn, or you could just learn by watching somebody else do it. Which path sounds, a little smarter and a lot less painful?
And this chart really drives the point home. The conventional way, what they teach you in business school, is to study all the success stories. Look at the winners. But Buffett's approach? He says to dissect the failures, study the mistakes that other people made. Why? Because you can learn so much more about what not to do by looking at what went wrong. And why is studying what to avoid so important? Well, because the reality of investing is that way more people fail than succeed. For every one person who hits it big, there are countless others who don't. So where's the bigger lesson? In that one success or in all those failures?
Okay, so let's recap. We've got simple math, check. Independent thinking, check. And learning from other people's failures, check. But there's one more thing, a kind of foundation that holds all of this together. And you could argue it's the most important piece of all. It's the quality of the information you're working with.
And this quote, wow. In today's world, with all the noise, the hot takes, the so-called influencers on social media, this has never been more true. Your decisions can only be as good as your information. It's that simple. That's why Buffett spends hours and hours reading, not flashy headlines, but high-quality journalism. And, yep, those boring annual reports.
So when you put it all together, this is it. This is the real investor's toolkit, straight from Warren Buffett. It's not about having a PhD or knowing some secret formula. It's about using the stuff you already have. Basic math, thinking for yourself, learning from mistakes, and making sure your information is top-notch. It's about common sense, courage, and just being curious.
So now you've got the toolkit. It's not some secret locked away in an Ivy League school. It's right there. The only question left is, what are you going to do with it? Whose mistakes are you going to learn from today?
When you hear the name Warren Buffett, you immediately think investing legend, right? But here's the thing. Some of his absolute best advice has nothing to do with stocks. It's about how we work, how we lead, and how we build a career. So today, we're going to dig into the wisdom of the Oracle of Omaha and see how we can use it in our own professional lives. You ready? Let's get into it.
All right, let's kick things off with a quote that, well, it kind of flips the script on what we're always told. In a world that's just obsessed with youth and disruption, Buffett goes the other way. He actually bets on experience. He believes that the kind of wisdom you get from being around the block a few times, you just can't teach that. For him, it's not just a nice-to-have, it's a real, powerful, competitive edge.
So, here's our game plan. We're going to break this down into 4 parts. First, how to hire. Then, how to lead. After that, we'll talk about the secret sauce for your own success. And we'll wrap up with how to sell yourself and your ideas.
All right, first up, hiring for character. This is basically the bedrock of everything Berkshire Hathaway is built on. It all comes down to getting the right people on the bus.
So when Buffett is thinking about hiring someone, he has this really simple 3-part checklist. He's looking for intelligence, sure. He's looking for energy, you bet. And he's looking for integrity. He says you really need all 3 to do anything special. But, and this is a big but, he is absolutely clear that one of these 3 things is way, way more important than the others. Any guesses?
Yep, you got it. It's integrity. For Warren Buffett, this is the one thing you absolutely cannot compromise on. Think about it. He says intelligence and energy, they're just force multipliers. And if you don't have integrity steering the ship, those amazing trades can become, well, really, really dangerous. And he doesn't mince words about the risk here. A smart, energetic person without integrity, they aren't just going to be a bad employee. No, they're going to actively hurt your business. He says they'll use all that brainpower and drive to figure out how to take your money and make it theirs. It's just a complete recipe for disaster. And look, this isn't just some nice idea he talks about. This is literally how he does business. Take the story of the Nebraska Furniture Mart. He didn't send in a team of auditors for months. No, he just went to the owner, the amazing Mrs. B, asked her how much the business was worth, and he wrote her a check for $40 million right there. Based on a handshake, he famously said he trusted her more than any audit. Now that is putting your money where your mouth is.
Okay, so that's how you build the team. But what happens next? Let's dive into our second part, leading with principle. Because once you've got those people with integrity, you have to manage them the right way.
Buffett sees 2 very different kinds of leaders out there. On one hand, you've got the reactive manager. You know the type. They wait for everything to catch on fire, and then they make some big dramatic announcement about a cost-cutting initiative.
But for the proactive leader, the Buffett way, managing costs isn't some big event. It's just what you do every day, like breathing. It's all about discipline and thinking ahead. And this leads to probably one of his most famous quotes ever. It just nails his whole philosophy on leadership, because when things are going great, when the economy's booming, hey, anyone can look smart. But it's when things get tough, that's when you find out what's really going on under the surface.
It's the perfect metaphor, right? A bad economy is like the tide suddenly rushing out, and it reveals all the companies that were built on hype or shady accounting. I mean, just think about a company like Enron. While the party was raging, they looked incredible. But when that tide of investor cash went out, poof, we saw they were swimming naked. There was nothing real there. The real measure of a leader and a business is how they hold up when the party's over.
Okay, so here's where things get a little unexpected. For a guy who lives and breathes balance sheets, Warren Buffett talks a surprising amount about love. Yeah, love. He says you could have all the money in the world, but you can't buy it. Be lovable.
So what does that even mean, a lovable workplace? Well, it's not about ping-pong tables and free snacks. It's way deeper. It's about respect. He finds people who are passionate about their work, and then, and this is key, he gets out of their way. He trusts his managers completely. He gives them the freedom to run their own show. He doesn't tear them down when they make a mistake, and he's their biggest cheerleader in public. That's how you build real loyalty. That's how you create a place where people actually want to be.
And that idea of hiring passionate people leads us right into our third point, the power of passion. Because we've talked about managing a team, but what about managing yourself? What's the secret for your career?
Here's the thing, and it's so important. For Buffett, real lasting success comes from falling in love with the process, not just the paycheck. The people who are genuinely excited about the work itself, they're the ones who become the best in the world. And the money? Well, that's just a happy side effect.
It's this funny little paradox, isn't it? The moment you stop chasing the dollar and you start chasing something you're truly passionate about, you get so incredibly good at it that the money just follows. You often end up making way more than if you'd just been grinding for a paycheck all along.
And Buffett has absolutely zero time for this idea of paying your dues in a job you despise. He uses this, let's say, memorable analogy to make a really critical point. Your life is happening right now. Wasting your prime years doing something that makes you miserable just for a resume line, it's a terrible, terrible deal. He's practically begging people to find the thing that makes them excited to get up in the morning.
And think about it, this stuff doesn't just stay at the office, does it? When you hate your job, you carry that stress and frustration home with you. It affects your family, your friends. But a job you love? That's totally different. You bring that energy, that excitement home. It's a choice that doesn't just define your career. It really defines your whole life. Okay, last section. Let's bring it all together and talk about how to actually make this happen. We're calling it finding your own way, but really, it's about knowing your value and being able to sell it.
Buffett has this great little story he tells. It's about a friend of his who was looking for the perfect woman. And the punchline is, his friend was so focused on what he wanted, on what he was buying, that he completely forgot that he had to be selling himself too.
And the lesson there is so simple, but it applies to everything. A job interview, a sales pitch, you name it. It's always a two-way street. You can't just walk in thinking about what you want to get. You have to flip it. You have to start by figuring out what they need. And then your whole job is to show them exactly how you can solve their problem. That's not just selling, that's how you build any great relationship, professional or personal. So there you have it. Integrity, proactive leadership, finding your passion, and always providing value. These aren't just feel-good ideas, they are the core principles that Warren Buffett used to build an absolute empire. So the real question for you and me is, which one are we going to put into practice first?
You know, Warren Buffett has some absolutely timeless wisdom when it comes to financial experts. And it all really comes down to one simple question. Who really benefits when you ask for advice? So today, let's dive into some of his sharpest insights on this. It all starts with this one simple, kind of brilliant quote. I mean, it seems obvious, right? Of course the barber's going to tell you you need a haircut. That's how they make a living. But for Buffett, this isn't just about getting a trim. He's saying this exact logic is the key to understanding all the financial advice you get. So what's the connection? I mean, a haircut and my 401k? Well, that little analogy, it's the key that unlocks the whole thing. It exposes these built-in conflicts of interest that you see all across the entire financial industry. It forces us to ask a really important question every single time we get advice.
And that leads us right into what you could call Buffett's golden rule. And the idea is pretty simple, actually. People who get paid to solve problems have a built-in incentive to, well, to find problems, whether they're actually there or not. And this goes way, way beyond just barbers. Think about it for a second. Investment bankers, lawyers, management consultants, their whole business model, a lot of the time, depends on making you believe there's a problem that they are uniquely qualified to fix. Because if there's no problem, there's no service to sell, and there's definitely no fee to collect.
You know where this idea gets really clear? When we start looking at market forecasters and analysts. Their job is to predict the future, but Buffett wants us to stop and ask, whose future are they really trying to build?
And wow, this quote just nails it, doesn't it? See, a forecast, it's not some pure, objective truth beamed down from a crystal ball. It's a product. It's created by someone who's got mortgages to pay, kids to put through college. They are paid to have an opinion, and that opinion is very often shaped by the need to get you to do something, which generates a commission. Okay, so this slide just lays it all out, plain and simple. Look at the two columns. Your goal on the left is probably long-term wealth, right? A buy and hold strategy, financial independence. But look at the industry's goal on the right. It profits from frequent trading, from constant portfolio changes. Your goal is to become financially independent, but their business model, it actually works better if you stay dependent on them.
So here's how the playbook works. Step 1, they create a reason to trade. Usually it's some big, scary forecast, interest rates are going up, earnings are going to be bad. Step 2, they convince you to make a move based on that forecast. And then step 3, the most important one for them, they collect a commission on that activity.
So you got to understand, this is the crucial takeaway. All this activity, all this frantic buying and selling, this constant churn in your portfolio, it has almost nothing to do with making you rich. It's the engine that makes Wall Street rich.
Okay, so how do they keep this whole system going? How do they justify all this? Well, that brings us to their next big tool, the complexity trap. The industry has a huge interest in making investing seem overwhelmingly, ridiculously difficult.
And Buffett really hits on something deep here, Why make things so complicated? Well, think about it. Because if investing seemed easy, if it was something you could do on your own, why would you ever need an expert? Why would you pay them? Complexity is their business model. In fact, there's this incredible phrase for it, a conspiracy against the laity. Just think of it like an ancient priesthood that guarded all the secret knowledge. By using jargon and creating these super complex strategies, the financial industry makes sure that regular people, that's us, the laity, feel like we need these high priests to interpret the magic for us. And there it is, right? The direct connection. The more they can make it all seem like some mystical, complicated game that only they understand, the more justified they are in charging you really high fees for their so-called expertise. But this is the question that just cuts through all of it. If these experts really have cracked the code, if they've truly figured out how to pick winning stocks, why on earth are they selling you advice? Why aren't they just sitting on a beach somewhere getting rich themselves? Maybe the real business isn't picking stocks, but picking fees out of your pocket. Now, it's not just complexity that's a trap. It's also popularity. Think about it. Advisors love pushing what's popular because it feels safe, right? Everyone's buying it. But Buffett warns that following the herd down Wall Street is one of the most dangerous things you can do.
But Buffett's warning here is that what's popular is not the same as what's smart. Our sources compare it to high school. The cool kids are never the cool kids forever. By the time a stock is the talk of the town, the big money, the easy money has probably already been made.
And this chart just shows you the trap in action. Look at that tall bar, the popular stock. It's already priced to the moon. That means you're paying a premium, taking on more risk, and for what? Probably lower returns. Buffett's whole strategy is the opposite. Find a great business when it's unpopular, that little bar on the right, and buy it at a discount.
So, okay, if we're supposed to avoid the forecasters, and we're supposed to avoid all the complexity, and we're supposed to avoid the herd, what in the world is left? Well, that brings us to the final and honestly the most powerful idea of all, just embracing simplicity. It's funny, in a world that sells you on complexity, Buffett's big secret is, well, it's that the simple approach is usually the most powerful one. Finding a great business at a fair price and just holding on to it for a really long time. It's not sexy, it's not flashy, but man, does it work. And this quote,
It just perfectly explains why you will almost never hear this simple advice from a brokerage house. Think about it. If they tell you to buy something and hold it for 30 years, they make exactly 1 commission. That strategy would build incredible wealth for you, but it would absolutely starve them.
So let's just recap the big mistakes Buffett says we need to avoid. First, stop believing that forecasters have a crystal ball. They don't. Next, always remember that your broker's goal is not your goal. Don't fall for the complexity trap. Avoid following the crowd into whatever is hot this week. And finally, resist that urge to constantly trade just because some expert on TV told you to.
And so, all of this, it really boils down to one last, very personal question you have to ask yourself. Take a good, hard look at your own portfolio, your habits, the fees you're paying, and be honest. Is your strategy truly designed to make you wealthy in the long run, or is it really just making someone else rich today?
So what if I told you that the single most common, most repeated piece of investment advice out there is just plain wrong? Today, we're going to dive into a really shocking philosophy from Warren Buffett that flips everything you think you know about safe investing completely on its head. Okay, just think for a second. What's the very first rule you ever learned about investing safely? You know the one. It's what every financial advisor says, what you read in every article, pretty much what everyone tells you. What is it? Yep, that's the one. Don't put all your eggs in one basket. And I mean, the logic seems totally solid, right? Spread your money around, minimize your risk. It's treated like the golden rule of investing. But what if it's not? All right, prepare to have your mind blown a little bit. Because Warren Buffett, arguably one of the most successful investors in history, says that for a lot of people, this advice isn't just kind of unhelpful. It's actively holding you back from real wealth. And boom, there it is. His bombshell quote. Buffett literally calls diversification a protection against ignorance. Just let that sink in. He's saying that if you've actually done your homework, if you really understand what you're investing in, spreading your money around is a huge disadvantage. So to explain why he thinks this, he uses this fantastic analogy. He says owning way too many different stocks is like trying to manage an unmanageable zoo. He calls it the Noah's Ark way of investing. You know, you just grab 2 of every kind of stock you can find and hope for the best. And what's the result? You end up with this chaotic zoo of a portfolio where there's no way you can give each animal the proper care and attention it needs to actually grow. This really spells out the problem, doesn't it? I mean, can you honestly be an expert on 50 different companies? No way. Your attention is just spread way too thin. It really is like juggling too many balls. You're just setting yourself up to drop everything. So if diversification has all these problems, why is it pushed so hard on us? Well, Buffett's got an answer for that too. He says all this pressure to diversify and constantly be active, it definitely benefits someone, but it's not you. Welcome to what he calls the Wall Street activity trap. This right here is such a game-changing insight. The entire business model of Wall Street is built on activity. They get paid when you buy, when you sell, when you turn your portfolio. But according to Buffett, how do you build wealth? By doing the exact opposite, inactivity. And this slide just lays it out perfectly, side by side. On the one hand, you've got the Wall Street way, all about activity, commissions, and constant noise. And on the other, you have the Buffett way, patient inactivity, finding a great business, and just letting its value build over time. These 2 goals are completely at odds with each other. Okay, so if we're supposed to avoid diversification and all that activity, what's the big secret? It's actually pretty simple, but it's incredibly powerful. Concentration. Instead of spreading your bets thin, you bet big on your absolute best ideas. Just let this number sink in for a minute. 90%. After a lifetime of investing, almost all of Warren Buffett's incredible fortune came from just 10 investments. He didn't get rich by owning a little bit of everything. He got rich by finding a few amazing opportunities and going all in. And hey, this isn't just a Buffett thing. Think about it. Bill Gates built his entire fortune with one company, Microsoft. The famous Omaha millionaires were just regular people who got rich by investing in one company, Berkshire Hathaway. The pattern here is crystal clear. Truly great fortunes are built through concentration, not diversification. Buffett loves to quote the actress Mae West, who said, "Too much of a good thing can be wonderful." And it's a simple but really profound question, right? If you find a truly amazing investment, a company you absolutely believe in, why on earth would you want to own less of it? Okay, so this is probably the most important part of this whole thing, so really listen up. This strategy has the potential to create massive, life-changing wealth, but, and Buffett is crystal clear on this, it is not for everyone. It all boils down to one simple question you have to ask yourself. Are you an expert? So you've got these two paths. On one side, you have concentration. That's for the hawk, the investor who has done the work, who understands the business, and who puts their eggs in one basket and watches it obsessively. Then, on the other side, you have diversification. That's the shield. It's sensible protection for people who just don't know the businesses they own that well. And there's zero shame in that, but you have to be honest with yourself about which path you're really on. So here's the final trade-off, all laid out. With wide diversification, you're basically playing not to lose. It's a strategy that will almost certainly protect you from going broke, but it's probably not going to make you rich. With concentration, you're playing to win. Now, the stakes are way higher, but that's where the potential for a real fortune lies. The choice is yours, and it depends completely on your knowledge and commitment. And that brings us to the final question, the one I want you to walk away with. Take a hard look at your own investments. Have you put together a focused, intentional collection of businesses you truly understand? Or are you running a zoo?
Today, we're going to try and crack the code on one of the world's greatest investors, Warren Buffett. We're going to unlock the simple but incredibly powerful philosophy that built his entire empire. And it all starts with a pretty strange puzzle.
So, let's start with that puzzle. Here's a quote from a guy worth over $100 billion, a man famous for living a super frugal life. He says, "I buy expensive suits, they just look cheap on me." What on earth could he possibly mean by that?
So yeah, why would one of the wealthiest people on the planet say this? I promise you, it's not some kind of joke about his fashion sense. The answer actually unlocks the three core virtues that his entire financial philosophy is built on. It has nothing to do with what he wears, it has everything to do with how he thinks.
All right, so the first virtue, and honestly, this is the bedrock of everything else, is discipline. But for Buffett, this doesn't start with some billion-dollar deal. Nope, it starts with mastering the small things.
See, Buffett truly believes that discipline is a habit, and you build it from the ground up. There's this famous story where he once turned down a simple $2 golf bet. Why? Because the odds were stacked against him. His logic is so simple, but so powerful. If you can't be disciplined with just $2, how can you ever be trusted with $2 billion?
Another huge part of his discipline, it's writing. Every single year, Buffett writes this incredibly detailed letter to his shareholders. He says there is nothing like writing to force yourself to think clearly. It's not just some annual report, it's the very tool he uses to sharpen his own investment strategy.
And that kind of personal discipline leads us right into the second virtue, prudence. You could say that if discipline is about mastering yourself, well, prudence is about protecting yourself from the madness of the crowd.
This is basically Buffett's mantra during a market frenzy. You know, when everyone else is getting greedy, buying anything and everything, paying insane prices, that is his signal to get more cautious, not less. He just refuses to get swept up in all the hype.
I mean, the contrast is just so stark, right? You've got the crowd, just buying in a frenzy, following whatever's hot, completely ignoring the price tag, and then you have Buffett's prudence, which acts like a shield. It keeps him disciplined, focused on demanding real value, and protecting his money from all that craziness.
And this brings us right back to that quote about the suits looking cheap on him. His prudence isn't actually about being cheap. It's about deeply, truly understanding the opportunity cost of every single dollar that leaves his wallet.
Think about it like this. For years and years, Buffett drove an old Volkswagen. Let's just say a new car at the time cost around $25,000. Now, for most of us, that's just the price of a car. But for Buffett, that money represents something way, way bigger. Because he knew that same $25,000, if he invested it and just let it compound at his average rate of return, could become nearly $1 million in 20 years. All of a sudden, that's not a $25,000 car anymore, is it? It's $1 million car. That's why he's so frugal. He literally sees the future hidden inside every dollar.
This way of thinking brings us perfectly to the third and final virtue, patience. This is the secret ingredient that lets discipline and prudence work their magic over time.
Buffett loves his powerful analogy from the legendary baseball hitter Ted Williams. Williams used to say the key to being a great hitter was just waiting for the perfect pitch, right in your sweet spot. Buffett realized investing is exactly the same, but with one huge advantage.
So this is what he's waiting for. A great business, one whose future you can pretty much predict, that for some reason is selling at a discount. But here's the real kicker. In investing, there are no called strikes. You can stand there at the plate all day, all year, and just wait for that one perfect pitch, and there's no penalty at all.
And he applies this patience to all of life's really big decisions. He even compares it to looking for a spouse. You've got to be out there, you've got to be interested and open-minded, but you absolutely cannot afford to be in a hurry. The great opportunities, like the right partner, are rare. You have to have the patience to wait for the right circumstances to show up.
So, there you have it. Discipline, prudence, and patience. But Buffett argues that these three virtues all point to one final, really profound truth: the single most important investment you will ever make in your entire life.
He asks you to imagine this scenario. Let's say you were given one car, and that's the only car you're ever going to have for your whole life. How would you treat it? You'd read the owner's manual cover to cover, right? You'd change the oil more than you needed to. You'd fix the tiniest little scratch the second it happened. You would protect that thing with your life.
Well, you only get one mind and one body in this life. You are that car.
The ultimate investment, the most important one you'll ever make, is in you. Your mind and your body are your greatest assets, period. They need the discipline of daily care, the prudence to protect them from harm, and the patience to let them grow over a lifetime. The most important business you will ever run is the business of yourself.
Discipline, prudence, and patience. These aren't just rules for investing, are they? They're really a code for living a successful life. Warren Buffett built an entire empire on them. So the only real question left is, which one are you going to invest in first?
So when you think of Warren Buffett, what's the first thing that comes to mind? Probably spreadsheets, right? Stock tickers, complex financial models. But what if I told you his single most powerful investment tool has nothing to do with math and everything to do with psychology? We're going to decode Buffett's playbook for mastering the market, which all starts with mastering your own mind.
And this right here, this one sentence, is basically the key to his entire philosophy. It sounds so simple, but it's a profound challenge to how our brains are wired. See, Buffett's real genius isn't about predicting what the market's going to do next. It's about understanding and, more importantly, controlling the most unpredictable element of all: human emotion.
Okay, so let's dig into the two core emotions that Buffett says are the biggest enemies of any investor. It's this constant tug of war in our heads between two incredibly powerful forces: greed and fear.
Now this is where it gets really interesting. Look at how this plays out. The average person, the crowd, sees stock prices soaring, and what do they feel? Greed, that classic fear of missing out. But Buffett, he sees those exact same high prices and feels the opposite. He feels fear. He sees risk where others see a party. And then, flip it. The market crashes, prices are in the toilet, and the crowd is panicking, right? That's when Buffett feels greedy. He's literally wired to do the exact opposite of the herd.
And here's the crucial distinction. Buffett isn't trying to be a psychic. He doesn't spend a single second trying to predict when the market's going to swing from greed to fear. He just knows that it will. It's a guarantee. This emotional cycle is baked into the system, and his whole strategy isn't about timing it. It's about being prepared for it.
So how does he actually do it? I mean, it's one thing to feel the opposite of everyone else, but how do you turn that into a repeatable strategy? Well, this brings us to what you could call Buffett's golden rule. It's all about merging the right temperament with the right intellectual framework.
And this is what he considers rational behavior. It's really a two-part recipe. Part one, you gotta have the right temperament. That's your ability to keep your own fear and greed in check, to not get swept up in the madness. Part two, you combine that emotional control with a solid intellectual framework. For him, that means focusing on the real long-term value of a business, not the crazy up and down squiggles of its stock price. Put those two together, and you've got rational investing.
And look, this isn't just some nice-sounding theory. He has actually done this for decades. In the late 60s, when the market was euphoric and everyone was greedy, he got fearful. He just stopped buying. So when the crash came in the 70s, what did he have? A big pile of cash ready to scoop up bargains.
He did the exact same thing during the dot-com bubble. He sat on the sidelines while everyone else was getting rich on tech stocks, and people thought he'd lost his touch. But then the bubble burst, and there he was again, with a war chest ready to go shopping.
Okay, so that's what being fearful looks like in practice. Basically, sitting on your hands while everyone else is partying. But what about the other side of that quote? What does it look like to be greedy when everyone else is absolutely terrified? Let's look at a classic example.
Let's rewind to 1990. The banking sector was an absolute mess. People were freaking out, thinking bad real estate loans were going to sink the whole system. The air was thick with fear, and nobody wanted to touch a bank stock with a 10-foot pole. For Buffett, this was music to his ears.
So while the crowd was in a mad dash to sell, Buffett went shopping. He did his homework, of course, found a bank he believed was solid, Wells Fargo, and then he pounced. He invested nearly $290 million right into the heart of the crisis.
And the result of being greedy when others were fearful? Well, it paid off, big time. Within a few years, that investment had multiplied in value. It was a masterclass in turning widespread panic into personal opportunity. His whole philosophy, right there in one perfect, profitable move.
Okay, so now that we've seen his strategy in action, let's look at the flip side. The things he tells us we have to avoid at all costs. He points out these specific psychological traps that so many of us fall into, even really smart people.
Trap number 1 is getting emotionally attached. We do this all the time, right? We start to treat our investments like they're people. We love a stock that made us money, or we get angry at one that's down. This quote from Buffett is just such a cold, simple reminder. The stock doesn't care about your feelings. It's a piece of a business. That's it.
So just take a second and be honest with yourself. Do you do this? Have you ever held onto a losing stock because you felt loyal to it? Or hesitated to sell a winner because you loved it? Just recognizing that you're doing it is the first giant step to stopping.
All right, trap number 2 is what Buffett hilariously calls the formula for financial folly, and it's a truly lethal combination. Step 1 is ignorance, just plain not knowing what you're doing. Step 2 is pouring gasoline on that fire by using a lot of borrowed money, or leverage. And what's the result? Step 3, which he just dryly calls interesting consequences.
And we're not talking about small mistakes here. The famous hedge fund Long-Term Capital, these guys were literal Nobel Prize winners. But they followed the formula perfectly. They borrowed a mind-boggling $100 billion, and when their bets went bad, the consequences weren't just interesting. They almost took down the entire global financial system. That's how dangerous this formula is.
The third and final trap is maybe the sneakiest one of all: envy. Buffett's take on this is just brilliant. He points out that of all the 7 deadly sins, envy is the absolute silliest. Why? Because you get no pleasure from it. It just makes you feel worse. It is a purely self-destructive emotion that leads to terrible decisions, especially with money. So, if envy is this destructive trap, what's the alternative? This brings us to the final and maybe most important piece of Buffett's mindset. It's all about replacing that toxic envy with the right kind of greed, what you might call a productive passion. And the difference between these two is everything. Envy is all about feeling bad because of what somebody else has. It makes you feel inadequate. Productive passion, on the other hand, is about a genuine love for the game itself, the process of analyzing businesses, of finding value. It leads to creating wealth, not just wanting what others have. This quote just nails it. The real goal isn't just to have more than the next guy. The goal is to get lost in the process, to truly enjoy the intellectual challenge of finding great businesses and watching your investment grow. That passion is a positive, sustainable fuel. Envy is just poison.
And that's what this all boils down to. The market's wild swings between greed and fear, that's a certainty. It's never going to change. The only variable in the entire equation that you have any real control over is your own response. So the final question Buffett leaves us with isn't about the market at all. It's about us. The market will always be emotional. The real question is, will you be?
You hear the name Warren Buffett and you immediately think investing success, right? But how did he actually do it? Well, it's not about some secret formula or a complicated algorithm. It's actually a pretty clear, timeless playbook. So today, we're going to unpack the core principles that made him an absolute legend.
And this quote right here, it's the key to everything. For Buffett, the biggest danger in investing isn't a crazy volatile market. Nope, it's your own ignorance. You know, knowledge is your absolute best defense against risk. So that is the billion-dollar question, isn't it? But here's the good news. Buffett has left a trail of breadcrumbs for all of us, and by following his playbook, we can start to build the kind of knowledge we need to invest with real confidence.
All right, rule number 1. First things first. Buffett doesn't hunt for stocks. He hunts for great businesses. Now, this is a huge shift in perspective. You're not just buying a ticker symbol, you're actually buying a piece of a real, living, breathing company. And he has this fantastic analogy about a boat that just, well, it gets to the very heart of his philosophy. What he's saying is that the quality of the business itself is the most important factor, even more important than having some genius CEO at the helm.
So let's break this down, because it really shows you the difference. In a great business boat, any decent manager can look like a total rock star because the business just works. It's like riding a champion horse. But in a leaking boat, even the best manager in the world wastes all their energy just patching leaks, never actually getting anywhere. You just can't win a race on a lame horse.
And to make this a little more real, let's look at some examples. For decades, Coca-Cola has produced fantastic results with all kinds of different managers. But industries like auto manufacturing and airlines, historically, they've been leaking boats, constantly struggling, even when they had brilliant leaders. You know, this wasn't just some abstract idea for Buffett. He learned this lesson the hard way. His own company, Berkshire Hathaway, actually started as a textile business. He poured a ton of money and effort into it, and he ran it as well as anyone possibly could. But the industry itself was just terrible. It was a business that wasn't worth doing, and eventually, he had to shut the whole thing down.
Okay, so you found a great business boat. Now, when do you actually buy it? Well, the second rule builds right on top of the first. You buy it when everyone else is absolutely terrified.
And this is where we see Buffett's famous contrarian streak in full force. He actually loves a bear market. Why? Because that's when wonderful businesses go on sale. He says you just can't buy what's popular and expect to do well, because by the time something is popular, it's almost always way overpriced. And hey, this isn't just a cool theory. I mean, look at his actual track record. This timeline of his legendary investments just proves the point. Disney, the Washington Post, Coca-Cola, Wells Fargo, every single one was bought during a market crash or a time of intense pessimism. He buys when things look their absolute darkest. He's also got a great sense of humor about where not to look for a deal. When he's talking about initial public offerings or IPOs, he jokes that the only time to buy them is on a day that doesn't have a Y in it, which of course means never. So here's the bottom line. An investment banker's job is to sell a brand new stock for the absolute highest price they can possibly get. There's no bargain there. But the irrational, emotional stock market? Oh yeah, it will eventually serve you up a fantastic business at a bargain price. You just have to be patient. All right, let's get to rule number 3. And this one might be the toughest of all, because it requires some serious psychological discipline. It's all about managing your investments and knowing when to hold on. And, just as important, when to let go. First off, you gotta be honest with yourself when you mess up. If you realize you're in a bad investment, a leaking boat, the absolute worst thing you can do is throw more money at it. You have to have the courage to just admit you were wrong, cut your losses, and get out before things get even worse. But then, and this is the total paradox, once you find a truly great business, that champion horse, you do the complete opposite. You hold on. You let it run. The big temptation is to sell and take a nice little profit and then go look for the next thing. But Buffett's advice is to just rest on your merits and let that great business compound your wealth for years and years. So if you put these two opposing ideas together, you get this really powerful concept we can call strategic patience. It's about having the courage to act decisively when you're wrong, and having the discipline to do absolutely nothing when you're right. It's a rare combination, but man, is it powerful.
Okay, so we've covered the 3 big rules of the playbook. But what's the one thing that holds it all together? What is the ultimate edge that actually makes all of this possible?
And this is where it all comes full circle. The real foundation isn't a secret at all. It's knowledge, which we talked about right at the beginning. And its close cousin, candor. Just plain, simple honesty. Honesty with yourself and demanding it from the companies you invest in. Buffett puts a huge premium on this. He truly believes that a CEO who isn't honest about mistakes in public probably isn't learning from them in private either. For him, a lack of candor is one of the biggest, brightest red flags you could ever find. And you can see exactly how this whole thing goes off the rails. A manager makes a big promise to make the numbers. But when they can't, they feel this immense pressure to, well,
Make up the numbers, and that path inevitably leads to total disaster, wiping out shareholders and employees along the way. Honesty isn't a soft skill, it's a financial necessity.
So, okay, how do you actually put all of this into practice? Well, it all boils down to one final test, a simple question that you absolutely must be able to answer before you ever invest a single dollar.
And this is it. This is the whole ballgame. You have to be able to finish this one simple sentence, and not with some vague hope or because you heard a tip from someone else, but with a clear, logical, business-based reason.
And really, that's the ultimate lesson from the Buffett playbook. If you can't clearly explain why you are buying a business at a specific price, then you don't know what you're doing. And as we learned at the very beginning, that's where the real risk comes from.
So, when you hear the name Warren Buffett, what comes to mind? Success, billions, maybe just being a genius at investing, right? But what if I told you his real secret wasn't about avoiding mistakes, but actually leaning into them? We're going to dive into his playbook and see how one of the world's greatest investors turned what most of us call failure into a seriously powerful tool for success.
Come on, we all have one. That one decision that just kind of lives rent-free in your head. Maybe it was a stock you sold way too early or a business idea that just fizzled out. That feeling of regret, it's a really powerful thing, and we're all pretty much wired to avoid it at all costs.
And that's really the core idea here. While most of us are basically programmed to see mistakes as a bright red stop sign, Buffett has a totally different way of looking at it. For him, they aren't just part of the game. They're the fuel that powers the whole engine. So how does he do it? Well, it really all comes down to 3 simple but honestly pretty powerful rules that anyone can use. Okay, so rule number 1, it's all about your mindset. It's about how you frame the past so it doesn't end up sabotaging your future.
And just listen to how final that is. He doesn't say, oh, try not to dwell on it. He says, we never look back. For Buffett, it's simple. There's just way too much opportunity right in front of you to waste a single second of mental energy on something that's already in the rearview mirror.
And you can practically see the 2 paths this lays out, right? If you make 100 decisions, but you only obsess over the 10 that went wrong, you just get stuck. You're totally paralyzed. You end up missing the whole new batch of opportunities that, especially in business and investing, show up literally every single day. The goal isn't to forget what happened, but to take those lessons and apply them to the problems of today.
Okay, so a huge part of living life forward is knowing the difference between 2 types of mistakes. Buffett calls them errors of omission. That's the stuff you miss, like not buying a stock that then goes to the moon. And then there are errors of commission. Those are the wrong actions you actively take. Buffett's argument is that the first kind, missing out, doesn't really hurt you. It's the second kind you've got to watch out for.
I mean, this just hammers the point home, doesn't it? The real danger is on the road ahead. You can't do anything about the opportunities you might have missed yesterday, but you can absolutely control the active decisions you make today. So it's time to stop kicking yourself for the train that already left the station and focus on not derailing the one you're on right now.
All right, so if you're going to live life forward and you accept that mistakes are just part of the deal, that brings us to rule number 2. You have to make sure you're making the right kind of mistakes. Just think about the incredible discipline in that statement. See, he's not even trying to avoid mistakes. He's trying to make sure that when they happen, they're explainable. They have to make sense. And really, the only way to do that is to only operate in areas you truly deeply understand. I mean, think about it. If your whole process is just a gut feeling or a hot tip, how on earth can you ever really learn when something goes wrong? You can't. But if you have a rational approach, you can clearly say, here's exactly why I made that call. And that's the only way to figure out where things went sideways.
And this is what he's famous for calling his circle of competence. It just means you know enough to tell a good business from a bad one. You have a logical, repeatable way to figure out what something is worth. Anything outside of that circle? Well, that's not investing. That's just throwing dice at a craps table. And as Buffett will tell you, ignorance in this game is a recipe for nightmares.
And that brings us to the final piece of this whole puzzle. So let's say you're focused on the future and you're committed to making understandable mistakes. There's still one huge hurdle, that fear of being wrong that just stops so many of us dead in our tracks.
I mean, that just completely flips the script, doesn't it? Mistakes aren't a sign that you're bad at making decisions. They're proof that you're actually making them. The simple act of choosing a path means you have to accept that some of those paths are going to be dead ends.
And this really breaks it down, you know? You've got paralysis by analysis on one side. That's when the fear of being wrong is so great that you just decide not to decide. But the problems just keep stacking up, and you end up following someone else. Leaders, on the other hand, they accept mistakes will happen. The important part is making the call so you can learn from it and move on to the next one.
You know, this reminds me of this amazing story about Seymour Cray, the absolute genius who designed the supercomputer. Someone once asked him what separated him from all his competitors, and he said it was his willingness to embrace mistakes. He said other engineers would stop after maybe the third failed attempt. Cray said he'd just keep going, even if it took 100 mistakes, until he finally got it right.
Okay, so let's tie all this together into a simple playbook that you can actually start using right now.
All right, so here is the Buffett playbook in a nutshell. First, live life forward. The past is a lesson, not a life sentence. Second, understand your errors. You do this by staying inside your circle of competence, which makes every mistake a useful data point, not a total disaster. And finally, decide and move on. Because progress only comes from action, and action, well, it inevitably involves a few wrong turns. It's a cycle of learning, not a series of failures.
And that really leaves us with this one kind of powerful idea, right? If the road to success is actually paved with mistakes, then making one isn't a sign that you failed, it's a sign that you're actually on the road. So the real question isn't if you'll make a mistake, it's what kind of smart, forward-thinking, and decisive mistake will you choose to make tomorrow.
So what if I told you the secret to Warren Buffett's incredible success wasn't some ridiculously complex formula, but a simple circle? Today, we're going to break down his circle of competence, an idea so powerful it could totally change how you make decisions, and not just with your money, but in pretty much every part of your life. This right here, this one sentence, is the absolute bedrock of Buffett's entire empire. It's not about some secret Wall Street code. It's just a radical commitment to common sense. Buffett's whole philosophy is this: if an idea is too complicated for you to get, the problem isn't you, it's the idea. It's that simple. Okay, so what is this circle of competence really? Just think of it like a line drawn in the sand around your own knowledge. Inside that circle are all the businesses and industries you truly, genuinely understand. You get their economics, you know what makes them tick, you can see where they're going long term. Everything else? Well, that's outside the circle, and for you, that area is completely off limits. So how does this one idea become the golden rule for smart investing? Well, it all starts with a really basic principle about what actually matters. Look, this has nothing to do with being a super genius with a 180 IQ. It's all about having the discipline to just be rational. This is the very reason Buffett stayed completely clear of the dot-com bubble. He just flat out admitted he couldn't predict what these tech companies would be earning in 10 years. So you know what he did? He did nothing. He just stayed away and let everyone else gamble. Okay, so that brings up the big question, right? How do you really know if something is inside your circle? Because let's be honest, it's pretty easy to fool ourselves. Well, Buffett has a brilliantly simple test for that. This is his personal litmus test. Think about it. Could you explain this investment to a friend, clearly, simply, and have them actually get it? If you start stumbling or using a bunch of jargon, or you hear yourself saying, well, it's complicated, that's a huge red flag. You probably don't understand it well enough to risk your own hard-earned money. The rule is simple. If you can't explain it, you stay away. All right, let's make this real. To see just how this test works in the real world, let's walk through a comparison that Buffett himself might make. Okay, imagine you have $44 billion to invest. Option A, you buy Yahoo, a tech company whose future is, let's be real, totally unpredictable. Option B, you buy U.S. Treasury bonds. They're basically risk-free, and hey, they'd actually earn you more money each year. So which path is easier to explain and predict? The crazy volatile world of tech or a simple promise from the U.S. government? And that's the core question, isn't it? Which one of these is a rational choice, and which one is just a gamble? When you apply that understandability test, the answer becomes crystal clear. You invest in what you can actually predict, not what you have to guess at. This brings us to the next critical piece of the puzzle, having the discipline to actually know your limits and to stay inside that circle no matter what. Buffett is absolutely adamant about this. Just because you're an expert in one thing doesn't mean you're suddenly an expert in everything else. True competence isn't about puffing your chest out about what you know. It's about having a sharp, honest awareness of what you don't know and having the wisdom to stay away from it. I mean, just take the incredible story of Mrs. B. She built a massive furniture empire, but she couldn't read or write. Her circle was tiny, but man, was it deep. She knew absolutely everything about buying and selling furniture. She'd buy with cash, in bulk, to get huge discounts. She owned her building to keep her costs rock bottom. And by just mastering her little domain and never straying, she died wealthier than most of the so-called geniuses on Wall Street. And you have to understand, this isn't just an investment philosophy for him, it's a management philosophy too. He applies this exact same logic to running his giant company, Berkshire Hathaway. He knows investing inside and out, but he doesn't pretend to know how to run a furniture store or an insurance company day to day. And get ready for this, because this number is going to blow your mind. Berkshire Hathaway has something like 180,000 employees around the world. But at corporate headquarters, there are only 17. 17. Why? Because Buffett's whole method is to buy great businesses that are already run by great people, and then he just gets out of their way and lets them do their job. Okay, so this all leads us to what is honestly the hardest part of this whole philosophy: having the incredible patience to do absolutely nothing. We live in a world that just screams action, action, action all the time. So Buffett's approach here is, well, it's radical. When there are no good opportunities inside your circle, the temptation is to just expand the circle a little bit, right? Lower your standards. But Buffett's rule is rigid. You don't. You just wait. And this isn't some theory he talks about. He actually did this. In 1967, he couldn't find any good deals, so he literally gave his partners their money back. And then he sat on the sidelines with cash for nearly 6 years. Then, in 1973, the market completely collapsed. And suddenly, the best companies in America were on sale. And who was ready with a pile of cash to go shopping? He was. That is discipline in action. At the end of the day, winning in this game comes down to two things. You need the right company, and you need the right price. If you only have one of those, you lose. And since finding both at the same time is pretty rare, patience isn't just sitting around. It's your most powerful strategic weapon. And that brings us to our final and maybe the most important section. After you've mastered all of this, who's the biggest threat to your success? Well, the answer might actually surprise you. As Buffett himself says, the biggest risks you face aren't out there in the world. It's not a recession or some change in interest rates that's going to sink you. The final boss is you. Think about all the ways we shoot ourselves in the foot. We get swept up in the herd, chasing some hot trend we don't really understand. We panic and sell at the very bottom of a downturn, locking in our losses. We constantly buy and sell, racking up crazy fees just because we feel like we have to do something. Every single one of these mistakes is a failure to just stay rational and operate calmly inside our own circle of competence. Ultimately, it all boils down to this one simple truth. The most expensive mistakes you are ever going to make almost never come from a bad spreadsheet. They come from emotion. They come from fear, from greed, from that frantic feeling that everyone else knows something you don't. That's what overrides rational thought. So, I'm going to leave you with this final thought. The next time you're facing a big decision, ask yourself, is the biggest risk the unpredictable market out there, or is it the person looking back at you in the mirror? All right, let's dive in. We're going to unpack a super simple idea from Warren Buffett. And I promise, once this clicks, it's going to completely change the way you think about investing. Forever. So, what's the one mistake that almost every investor makes? According to Buffett, it's the single fundamental error that just traps so many people. You know, it's what causes them to buy high, sell low, that whole cycle of panic and euphoria. So what is it? Well, it's all about confusing two things that are completely different. And that right there brings us to the absolute core of the Buffett mindset, the crucial difference between price and value. I'm telling you, getting this distinction is the key. It's how you escape that trap and really start thinking like you own the place. This quote right here, this is it. This might just be the most important sentence in all of investing. Price is what you pay, value is what you get. Now, it sounds ridiculously simple, right? But here's the thing. They are not the same, not even close. In fact, a lot of the time, they're miles apart. So let's really dig into what that means. Okay, let's put these two head to head. Price, think of that as just the flashy number on the screen. It's what everybody's talking about. It jumps around based on fear, greed, whatever the headline is that day. It's totally short term. But value? Value is the long-term reality. It's what that business is actually worth, based on how much cash it can make over years and years. Now, figuring out that exact number is a whole other conversation, but it's the principle that's absolutely crucial. Okay, let's make this real. Picture a business, a good one, that reliably makes 10 million bucks a year in profit. Simple enough. That earning power, that is its value. That's what you're actually getting. Now, let's say the market, in its infinite wisdom, slaps a price tag on this whole business for $100 million. That's the price. That's what you have to pay to get in. And here is where the magic happens. What if you could buy that exact same business, the one still making $10 million a year, but you only had to pay $75 million for it? Boom, you just found yourself an amazing deal. You paid way less for the exact same thing. And that gap, that space between the price you pay and the value you get, that is the whole game right there. All right, so step 1, understand the difference. Got it? Now for step 2, using that knowledge to completely flip the script on your relationship with the stock market. It's time to put you in the driver's seat. You see, for Buffett, the stock market isn't some all-knowing guru telling you what things are worth. Not at all. It's more like a really moody, manic business partner. One day he's ecstatic, the next he's terrified, and he's just constantly shouting random prices at you. Most of them don't make any sense. It's just a tool. That's all it is. And this is the big mental flip. The market exists to serve you. All those crazy price swings, the panics, the moments of insane excitement, those are just opportunities. They're signals for a smart investor to look for those moments when price is totally disconnected from real value. You don't take your marching orders from the market, you use its moods to your advantage. So you've got a choice to make, right? You can see the market as your teacher, which leads to FOMO and panic selling. Basically, the market is in control of you. Or you can see the market as your servant. And when you do that, you're in control. You get to use its emotional outbursts to make your own calm, rational moves. This leads us right into the psychology of it all. You know, understanding the mental traps that snare so many people. And here's the thing. It's a pattern that just repeats over and over again. And once you see it, you'll start noticing it everywhere. This quote is it's such a killer insight into how we all behave. The wise investor, they get in at the beginning, when things are quiet, the fundamentals look good, and the price makes sense. They're focused on value. The fool, they jump in at the very end, after the price has gone to the moon, buying into all the hype, usually right around the time the wise investor is cashing out. And that's the perfect setup for talking about speculative bubbles. A bubble is what happens when prices are driven by nothing more than emotion and the hope that you can sell it to some other person for more money later. Price totally detaches from reality. But as Buffett says, there's always a pin waiting for every bubble. And that return to reality, well, it's sharp and it's painful. And look, this isn't anything new. If you look at history, this cycle pops up roughly every 30 or so years or so, and it's almost always kicked off by some exciting new technology. It happened with radio, then with cars, then the internet. The specific tech is always different, but our human psychology, that tendency to swing from being rational to just wildly speculating, that never changes. Okay, here's another classic mental trap: the bidding war. It doesn't matter if it's for a company or even a house on your street. That deep down desire to just win can be so destructive. And Buffett's advice on this is, well, it's the exact opposite of what you'd think, but it's pure genius. Let's walk through how this goes down. At the start of the bidding, everyone's logical, but pretty soon that competitive juice starts flowing. The desire to win takes over, and with every single bid, the price goes up and up, which means the value you're actually getting for your dollar goes down. So the person who wins the auction often ends up paying such a crazy high price that they've basically guaranteed they'll lose money on the deal. They won the battle, sure, but they definitely lost the war. So how do we pull all this together? How can you make sure you're always focused on value, not price? Well, Buffett has this incredibly simple but powerful mental test that just forces you into the right frame of mind. Just pause and really think about this for a second. What if, right after you bought something, the market shut down and you couldn't sell it for 5 years? Would you still make that purchase? See, all of a sudden you wouldn't care one bit about the daily price wiggles. You'd care a lot about the actual health of the business and its ability to make money over the long haul. You'd have no choice but to think like an owner. And that is the ultimate shift. You're not just buying some ticker symbol that bounces around on a screen. You're buying a piece of a real-life business, a company with actual buildings and people and products. The stock certificate, that's just the receipt. The business itself is where the value is. So I'll leave you with this final thought. The next time you're thinking about buying anything, just stop for a second and ask yourself this one question. Am I just caught up in the price, or am I actually getting value? Trust me, how you answer that question, it makes all the difference in the world.
You know, Warren Buffett has built this incredible multi-billion-dollar empire, and he did it by taking advantage of a single fundamental weakness in the stock market. Now, it's not what you think. It's not some crazy algorithm or some secret insider info. No, it's actually just a simple shift in mindset. It's a way of thinking that turns all that Wall Street panic, all that short-term chaos into a massive advantage for the patient investor. So let's dive in and break down exactly how he pulls this off.
Buffett has this brilliant way of explaining it all with a baseball analogy. Think about it like this. You're up at the plate, ready to bat, but there's a twist. There's no umpire calling strikes. None. So you can just stand there all day long. You can let thousands of pitches just fly by. You don't have to swing at the bad ones. You don't have to swing at the mediocre ones. You don't even have to swing at the pretty good ones. You can just wait and wait with like infinite patience for that one absolute perfect pitch right down the middle. Only then do you even think about swinging. And that right there is the core of his entire philosophy.
And this really shows you that there are two totally different games being played here. On one side, you've got the professional money managers. I mean, their clients are basically screaming at them, "Swing, you bum," every second of the day. They live and die by those quarterly results, which forces them to chase every tiny little price move. But then, on the other side, you have Buffett's game. And it's the total opposite. It's quiet, it's patient, it's all about just ignoring the noise and focusing on the one thing that actually matters, the real long-term value of the business. All right, so let's dig into this short-term game first. What is it about this way of thinking that creates such a huge opportunity for anyone who's just willing to, well, think a little differently?
This is the trap that, honestly, most fund managers are caught in. It's a really vicious cycle. See, they're under this insane pressure to get results, like right now. A single bad quarter and boom, clients start pulling their money out. So to keep everyone happy, they have to go chasing short-term profits. And that forces them to make really short-sighted decisions. They're not really buying pieces of businesses, they're just betting on numbers bouncing around on a screen.
And look, this isn't some new thing. As Buffett loves to point out, people just make the same mistakes over and over and over again. This whole cycle of chasing prices, paying way too much for hype, and then panicking at the first sign of trouble, it's a totally predictable pattern. It's just human nature, and it's basically baked right into the DNA of the market.
Okay, so if that's the problem, what's the secret to actually taking advantage of it? Well, it's about seeing the one thing, really the only thing, that all this short-term noise is designed to hide.
The secret's actually pretty simple. You have to understand the difference between a stock's price and its value. That daily stock price, that's just a number bouncing all over the place, totally driven by emotion, fear, greed, the latest quarterly report. But the long-term economic value, now that's the real prize. That's the true underlying worth of a company based on its power to generate profits, year after year after year.
And here's the crucial takeaway. Wall Street's obsession with that short-term stock price, it means they are constantly getting it wrong when it comes to a company's real long-term value. They're making mistakes all the time, and Buffett's entire career, his entire fortune really, is built on just patiently waiting for those mistakes to happen and then capitalizing on them.
All right, so let's get into how this philosophy actually translates into real-world results. This is where the rubber meets the road, where we see exactly how Buffett turns the market's folly into his own fortune.
This quote just flips the whole script. I mean, think about it. For most people, a market crash is a total disaster, right? For Buffett, it's a fire sale. He doesn't see market panic as something to be afraid of. He sees it as a friend, offering him incredible bargains on amazing companies. He profits from the craziness. He doesn't get swept up in it.
And history shows he absolutely puts his money where his mouth is. Just look at these dates. We're not talking about little dips here. These were moments of pure maximum fear and panic. And while pretty much everyone else was selling everything they had and running for the exits, what was Buffett doing? He was calmly going shopping.
I mean, just look at these numbers. They're staggering. During the big crash in '73, he put $10 million into the Washington Post. That $10 million turned into $1.5 billion. After the '87 crash, he bought $1 billion worth of Coca-Cola. That's now worth over $8 billion. It's just incredible. He turned complete market chaos into generational wealth, all by just focusing on long-term value when absolutely no one else was.
And it isn't just about huge market-wide crashes either. Take the Geico story. The company was literally on the verge of going bankrupt because of a big miscalculation they made. So the short-sighted market, they saw disaster and they panicked. But Buffett, he looked right through that and saw a fantastic business that just had a temporary correctable problem. He put in $45 million. That investment, it became $2.3 billion.
So how can we start to develop this same kind of mindset? Well, it all starts with a really simple but incredibly powerful thought experiment.
Okay, I want you to really think about this for a second. Ask yourself this question. If you bought a stock today, and then the stock market shut down completely for the next 10 years, what one company would you be happy to own? See? That simple question forces you to forget all about the short-term price chatter and start thinking like a real business owner.
And this 10-year test, it just makes you focus on what actually matters. You start asking the right questions. Does this business sell something people will still want and need in a decade? Is it super profitable? Does it have to constantly reinvent itself, or is its future pretty stable and predictable? Suddenly, you're thinking about quality and durability, not just the next quarterly earnings report.
Buffett has this brutally sharp way of explaining the difference between just playing the market and truly investing. He says that calling an active trader an investor is like calling someone who has a bunch of one-night stands a romantic. It's just not the same thing. One is just a fleeting transaction, the other is a real long-term commitment.
And this really lays it all out, nice and clear. So what are you? An investor buys a piece of a business, focuses on its growth over time, and, aims to get rich slowly. A speculator? They're just throwing dice on which way the price is going to go. They're focused on short-term trades. One of these paths makes you rich. The other one? Well, that one makes the fund managers and the brokers rich from all your trading fees.
And really, this is the ultimate mindset. This is the culmination of this whole philosophy. The stock market isn't your guide. It's not a crystal ball telling you what to do. For Buffett, he says as far as he's concerned, it doesn't even exist, except for one thing. It's just a reference point. A place to check in every once in a while to see if somebody, anybody, in the midst of all that panic is offering to do something foolish, like sell you a great business at a ridiculously low price.
So that really leaves us with one final thought, doesn't it? The market offers two different games you can play. One is frantic, it's stressful, and honestly, it's pretty much designed for most people to lose. The other game, it's patient, it's calm, and it has been proven time and time again to build incredible wealth. So the only question left is, which game are you playing?